Hello there and welcome to the week ahead with me, Fiona Singh-Cotter, Senior Market Analyst at City Index. And this is for the week which is beginning the 7th of July. So just as always, I will ask you to read through the risk warning. I'll just put myself on mute whilst I do. Okay, so let's start by having a very quick recap of what's been going on this week. So we've had a lot going on as far as the data is concerned, as far as the bills are concerned in the US. So this is the S&P 500, reached all-time highs on Thursday. That was at 62.84. Record levels came after the non-farm payroll actually came in stronger than expected, with 147,000 jobs added in June. That's up from the 110,000 expected. We also saw unemployment fall unexpectedly to 4.1%, down from 4.2%, and also below forecasts of 4.3%. So there was definitely a resilience that was seen in the US jobs market, and that relief really helped push stocks higher. Also, inflationary pressures weren't high. In fact, average wages eased to 0.2%. So, just that prospect of potential slightly easing inflationary pressures also helped. I mean, at the end of the day, it took the prospect of a Fed rate cut in July off the table, and we've also seen investors rein in rate cut expectations for September. But even so, we did still see the S&P 500 get to record highs, despite the prospect of slightly less easing from the Federal Reserve this year. The market's pricing in 50 basis points worth of cuts, down from 65 prior to the reading. Now, if we just look here, though, we are seeing that the S&P 500 is coming off slightly. That's as attention turns towards Trump's tariffs next week, but more on that in just one second. I just want to pull up the other one, which is the US dollar, which has fallen to had fallen to 3.5-year lows this week, continues to hover around those 3.5-year lows. We did see a slight pickup yesterday after that stronger than expected data from non-farm payrolls, seeing some weakness again today as attention turns to those trade tariffs. So let's just have a look. I think, first of all, I mean, whilst this is the economic calendar, which, as we can see, there are a couple of notable things. There's retail sales in Europe, RBA meeting, Chinese inflation, FOMC minutes. Despite all of this, the focus is going to be headlines. So, I mean, the US is closed today for Independence Day, and whilst the US is closed, as in the stock markets aren't open, that means that this news of Trump passing the big beautiful bill, or should I say the House of Representatives passing the big beautiful bill, is yet to be played out really in the markets. So as well as coming back to that, the markets will also be coming back to the news that sorry, just bear with me whilst I'm putting up the NASDAQ. It's also coming back to news about tariffs. So this big tariff deadline, July the 9th, this is a key date that basically the market has been focusing on. It's the pause. It's when we have the end of the pause in reciprocal trade tariffs. So we had 90-day pause on reciprocal trade tariffs that were announced in April. And we've heard from Trump today saying that the administration will probably start notifying trading partners today, on Friday, of their new US import trade tariffs, which will become effective as from August the 1st. Now, he's also said that the tariffs will likely to range between 10 to 20% or 60 to 70%, so a very broad range here. And so this is creating a lot of nervousness as far as the market is concerned. I don't think with the stock market trading at record highs, it's really been taking in or fully being priced in the risks associated with these trade tariffs. Potentially the market is a little bit complacent that maybe there'll be room for negotiation, maybe there'll be room for them to be pushed back again, as we've seen in previous as we did see with the reciprocal tariffs. But the other thing to keep in mind here is there are still some major economies such as Europe, the European Union, sorry, Switzerland, which are at a critical stage in negotiations, although they haven't got a finalized deal yet. Also, India looks like it might be crossing the line soon, but Japan does not look like it's going to be finalizing a deal soon. So these are major trading partners, major economies, which could actually end up with pretty steep reciprocal or trade tariffs with regards to the US. So there could be a potential for a fairly big amount of headline-driven volatility next week, and that is likely to be the key driver of the markets. Obviously, if we get sort of, you know, the markets are concerned by the level of tariffs that Trump is announcing, then that could very much fuel that sell America trade that we had seen in previous in April, and you know, that's down here, that's where we've seen recovery from. Now I don't think we're going to get back down there because that was sort of like worst case scenario and uncertainty, but you know, there is a potential, and we have seen some trade deals done, but there is a potential for increased volatility. Obviously, if the trade deals are excuse me, less harsh than expected, then that could see actually an extended recovery, but I think that might be a little bit optimistic. I think we might be looking at more of a volatile downside week if those trade deals, if those trade tariffs are more concerning. So this is the NASDAQ. As we've seen, it's breaking above this rising trend line that it was trading up against. We're just below that 23,000. We're on the way down. I mean, these are the futures today. As I said, the stock's chart. As far as support is concerned, and it's interesting because we did just see it tip into overbought territory, in fact, but as far as support is concerned, this is level 22,500 levels we're watching on the downside. That's the round number. It's a level that proved to be quite important across last week, but it's also the support of the rising trend line. Below that, we've got this level here, which is the 22,245, which is the high that we saw back in February. And then below that, the 22,000. Now, you know, even up to 22,000, the uptrend stays intact. I think if we get a break below 22,000, that's going to negate that near-term uptrend and potentially open the door to 21,500. A break below there is what's going to create a lower low, changing the structure of this chart. So let's just have a look what all this means as well for US dollar, Japanese yen. As I said, that Japanese yen potentially struggling to get a deal over the line, but that hasn't really had a massive impact on the currency. It's very much trading in this holding pattern that we're seeing here, just because if we do find that there are higher tariffs being placed on Japan, that could potentially slow growth and that also then means that the Bank of Japan may struggle to hike interest rates as it planned. We've heard that sort of, them talk about underlying inflation is still not quite where they want it to be, although headline inflation is well above the 2% target. So Bank of Japan are just likely hanging on in there to find out what these tariff rates are going to be. Potentially we could see some weakening of the yen if Japan is highlighted as a notable or a country that's been hard hit by tariffs. But obviously the yen is also a safe haven play, so that may help to balance things out, especially if we do see a sell America trade as well. So levels to be watching. If we do see sell America trade, then be looking at the 142.50 on the downside. That's the support zone. On the upside, the 146 level is a pretty key level. If we get above there, then that could create a higher high looking towards the 148.60 level. Just whilst we talk about safe havens, I think it is worth actually taking a look at what's going on with gold. So gold, obviously, we had those highs that we saw when we were trading in the Middle East tensions and the short 12-day war between Iran and Israel. Since then, we've seen gold prices come lower, falling to a low there of 32.50. Actually, just seeing the price is now hovering around the 20 SMA, which is around the 33.50 level. If we're getting some concerns, and I think this is sort of a little bit of an uptick here, a couple of things to bear in mind here. The big beautiful bill impact, it could be inflationary, also that is expected to increase the debt pile in the US, so those sort of worries do tend to boost sort of safe haven demand. Also the weaker US dollar on the back of that also could be offering some support to gold prices, but if we get some surprises and some heavy hitting tariffs, then gold could rise quite quickly back up to the 34.50 level on the upside. Just as far as support is concerned, 3,300 on the downside. It's worth remembering we did actually see gold fall when we had that initial tariff announcement, and that was because gold was liquidated in order to cover off positions in equities. So that's why we saw that, but then it quickly reversed and moved higher. If we do see a sort of very sharp fall in equities, then there is a potential that we could see a similar phenomena as well in gold prices. So, I mean, really, as I said, it's going to be so much focus on these trade tariffs and what they mean for the economy going into the second half of the year. Just elsewhere, I mean, let's just stick with the US. We've also got the FOMC interest rate, the FOMC minutes to contend with next week. So just to remind you, these were the minutes which relate to the meeting, the FOMC meeting, which is on the 17th and 18th of June. These meeting minutes could actually be considered a little bit stale now, given that we've heard from Federal Reserve Chair Jerome Powell on several occasions since the meeting. We had the testimony before Congress, and we also had the ECB's Sintra central bankers forum. So there were plenty of occasions to hear from Powell. And actually, I mean, at the meeting, the FOMC left interest rates unchanged at that 4.25 to 4.5%. And the dot plot pointed to 50 basis points worth of cuts in 2025. Now, since then, Federal Reserve Chair Jerome Powell, at that meeting, he also warned over the inflationary impact of Trump's tariffs. However, since then, we have had a slightly more dovish stance from Powell, who sort of said that if the inflationary pressures don't start showing through in the inflation data, then the Fed could continue cutting interest rates. So, and we haven't seen the data showing that yet. I mean, not only have we seen strong jobs reports, we've seen inflation only tick very, very modestly higher, nothing coming through, although it's still obviously very early days. But if we do get a slightly more hawkish stance from other policymakers at that meeting, then we could see the strengthening of the US dollar. But I think it's worth pointing out that I think there was a sense of, or there has been a sense of more policymakers just sounding a little bit more dovish if that inflationary pressure doesn't show through, because it's difficult to know still so far how many businesses are actually passing on the increased costs from tariffs. And so, you know, until the data starts showing it, the Fed are still a little bit cautious about what to do next. This is pound US dollar. Just wanted to bring it up. Obviously, we're not really talking about what's going on the pound here. We're focusing on the dollar next week because there's not so much in relation to the pound. But we did see a pretty big move in the pound on the week we've just had. And I think it is worth keeping in mind that politics in the UK will be in focus. Just because there are rising expectations that the UK may need to raise taxes in the October budget, particularly after this welfare U-turn that we saw this week, which means that any headroom that the government had has effectively been wiped out. We saw Rachel Reeves emotional in Parliament, raising questions about her whether she'll be staying, although that has now been confirmed after Keir Starmer backed her on Thursday. So there's been quite a lot of political issues going on for the pound, which is why we saw it drop lower, but it is still in this upward trend. I think the thing to be watching here for me is, whilst we're in the upward trend, there does seem to be a sense that the momentum is slowing. So there is a bit of divergence going on between the RSI and the move higher. We have seen this level here acting as a pretty solid support, the 136 level. That was the low that we saw yesterday and the day before. And as I said, the uptrend is still intact. We'd need to see much more concrete evidence of a reversal than just the bearish RSI divergence. But if sellers break below that 136 level, then that could open the door to 134.50, which is a pretty key level as far as creating a lower low is concerned. On the upside, 137. Oh, sorry, on the upside, 137, almost 138 is the high that the market reached and that buyers will need to get above in order to create a higher high. It just does seem that, I mean, if we get US dollar weakness, then that could help the pair to push higher. But those political issues in the UK could limit the upside. So let's talk Europe as well. Sorry, we're just going to have this Eurozone retail sales. Eurozone retail sales, they had a pretty strong performance in April. We'll be watching out for those in May. Again, I think, you know, Eurozone retail sales really are going to be playing second fiddle to trade news. If we get a trade deal agreed with the EU over the weekend, I think that's going to be some encouraging news to start the week. Remembering that the euro has been a big benefiter from the US dollar weakness. If we do get concerns over the level of Trump's trade tariffs, that could be revived, that bet, pushing the euro US dollar higher towards the 119 level. On the downside, it's worth also keeping in mind that if there are very high tariffs against Europe, that could impact growth which is at the moment, growth is a little bit of a problem story for the ECB. I mean, they've got their inflation back to the 2% target, but they are just struggling to get the growth really going. And if we get to a strong euro, then that could be a problem for growth as well, but we're still some way away from that. I think you would need to be above the 120 level in order to be concerned at all about a strong euro. So just as far as other points to note, we've got the RBA interest rate decision, which is coming on Tuesday. Now they are expected to cut interest rates for a third time, basically to support the slowing economy. 25 basis point cut is expected 3.6%, and that comes after the previous meeting was more dovish, and the guidance was more dovish than expected. So that's what sort of fueled expectations now of further rate cuts. We can see the pair, the Aussie US dollar has actually been grinding higher, but it's really struggled at this resistance point here as the 0.66 level. Basically, that's where it struggled to push higher. But the RBA is, as I said, expected to cut in the meeting next week. It's expected to cut at least once more as well towards the end of the going out towards the rest of the year, if not twice. And that comes as official data showed that the economy grew just 0.2% in Q1, amid signs that consumption is softening. There's also sort of a lack of a trade deal with Australia and the US ahead of the July 9 deadline, which is also a cause for concern for the RBA, because obviously no trade deal is going to potentially slow the economy further, could have a deflationary impact. Now, inflation has caused 2.1% in May, so it is back down pretty much to the, that target for the RBA. And basically, so I think the concern here is what's going to be happening with trade. Will it impact the outlook for economic growth, which is a little bit stagnant at best? So as far as levels to be watching, I mean, obviously there's also this US dollar story that we're going to have to be keeping up with as well. But as far as levels are concerned, we've got these levels down here, which were the lows of yesterday and the day before, which is around the 65.40 level. That's also the highs that we were seeing just in mid-June. But it would take, would need to break below 65 in order to break out of that rising channel and to expose the 200 SMA at 64.20. As far as the upside, if we do hear of a slightly more hawkish sounding RBA, then we need to rise above that 66 level to create a higher high. And after that, I mean, just having a look here at what's going on, would be looking up towards sort of 67 as the next level on the upside. The Aussie could also be impacted as well by Chinese inflation data, which is also due to be released. I'm just going to pull up oil prices because oil has been something which is also going to be affected by by Chinese inflation as well as by US trade tariff expectations. Now this is the oil price. It's a bit of a messy chart, but let's just have a look here. You see, so we've got this, we're in this downward channel that we've been in. We didn't really break out of it meaningfully with the Iran-Israel war, dropped back here to the low at the 64 level, and just really hovering around this level. This is the 66 here. The price is just being capped here by that 20 SMA. It's being supported on the underside by the 50 SMA. But yeah, we do really need a rise above that 67.50 level in order to expose the 200 SMA there at 68.50, and above there 70 comes into play. But if we, with the Chinese inflation, let's not forget that it fell for a fourth straight month in May. which really suggests that stimulus measures from Beijing are proving insufficient really to boost the domestic consumption. If CPI fell 0.1% year on year. We've also seen deflation at factory gate level with PPI, which fell 3.3% year on year in May, marking the steepest decline since July 2023. Now, PPI is considered a lead indicator for CPI, so we could see that deflationary pressures transferring across to weaker CPI. But again, not necessarily ideal for any signs of recovery. Other reason that we're looking at oil right now is we've got the OPEC meeting. So, you know, we're looking at potentially weaker jobs, weaker inflation data from China, potentially a weaker demand outlook if there are high tariffs. And then we've also got OPEC, who are expected to announce a 411,000 barrels per day increase in oil again for August, the same as what they did for May, June and July. So that would be an increase. Then we're talking about 1.5% in the total oil demand, which has been increased in supply. So obviously this is going to start having an impact. I think it does mean that any upside in oil prices may be limited whilst we have OPEC increasing output. So that is everything for me. Just taking a quick look here, RBA. So we've also got the RBNZ rate decision and Canadian jobs data on the Friday. So I hope that you've liked everything that you've seen today, and if you do, then great. We look forward to seeing you again next week.